We now move to the next part of financial management under Unit 2, and we talk about valuation of common stocks now. So far, we were looking at valuation of bonds and how does the cash flow get discounted to arrive at the current present value of the bond and thereby find the bond's price. We are now going to replicate a similar process to the pricing of common shares or stocks or equities of a company. Now, broadly, equity of a company is nothing but a sort of a profit sharing agreement where someone has given money to the company and they have a part ownership in the company to the extent of what number of shares do they hold in the company, right? So, unlike a bondholder only has claim to the specific portion of the coupon payment that is going to come. The equity holder, on the other hand, has a claim to broadly the proportionate share of profits that are there in the company, right? So we'll try and value the company's stock now using similar principles that we have learned so far under the present value concept of finance, right? There are a few topics that will follow. We'll talk about valuation of common stocks. We'll talk about various cases and try and build a case for discounted cash flow models. What are the various scenarios that come up? We'll start with the simplest of scenarios and then try and kind of increase the complexity or remove the assumptions that we take. Then we also talk about something called as price to earnings multiple, which is a case of essentially relative valuation. And then we talk about the discount rates in this case. So unlike bonds where the discount rates are kind of evident in terms of market interest rates, here the discussion on discount rates also kind of becomes a little bit more complicated. Some part of that we'll cover at this point of time at this juncture in our curriculum. Subsequent units of our curriculum will also talk about this discount rate in more details. Right. So let's first try and kind of understand the concept of raising money via common stocks. So far, we were considering that a company is raising money using some kind of loan, right? Some kind of loan or borrowing or debt. Now we are extending this analysis to companies raising money via ownership in the company, right? So this brings in a new set of securities called stocks or shares, as they are commonly called. Why are they called shares? Because simply put, a 10% share in the company means a 10% entitlement to the profits and assets and everything that the company owns, essentially, right? So if this is the company's profits and if I own 10% of the share of the companies, this part of the profit is mine, right? The company may choose to give it to me at that point of time or might choose to give it to me at a later point of time, but practically this part of the company's earnings is entitled to me essentially, right? Now that's where a lot of the interesting premise on equities comes in. The company is issuing stocks as securities as well. There must be a similar way of valuing them, right? All we need to find out is if we do get a set of cash flows from these equities or stocks or shares, as we call them interchangeably, and then we could discount these cash flows. So that should be the logical modus operandi or way of valuing a stock as well, right? We need to find out that if someone holds this security, what is the cash flow that will come to them? Now, once someone holds a security, whether it is a stock or a bond, we are not bothered about what is the kind of the security that is there. All we are bothered about is what cash flows come out of it and what is the expected return out of that security, based on which I should arrive at a particular price that someone should be willing to pay as a buyer of this particular security, right? So practically speaking, if the company makes a payout every year, this is the cash flow that will accrue to that needs to be evaluated every year, that will accrue to the shareholder, right? The value of the common stock should thus be the present value of the cash flows that the company gives for its period of existence. Let's say it exists for n years. Every year the company might give out some cash flow. Every year there is an expected rate of return that is there, I have to discount it to find the present value of all these set of cash flows, and that present value when added together will give me the price, just like our bond concept, right? In the bonds case, this cash flow in the numerator was the coupon rate, the discount rate was the yield that I wanted from a bond, and N was the maturity of the bond. Here, whatever cash flow the company gives is the cash flow that we take. The rate of return is the expected rate of return from the company's stock or stock price. And finally, the number of years of existence of the company. Now, there are a few issues or complications that arise when you're evaluating a stock as against a bond, right? What are these issues? Issue one is that unlike a bond where these cash flows are kind of fixed because they are coupon payments, the numerator in the equation is fixed, the cash flows in equities are not fixed. Rather, you have to project them or actually find out what these cash flows would be. We don't know what these cash flows would be upfront. In the case of a fixed income security, the name fixed income suggests that the income or the cash flow every year is kind of fixed. So to that extent, it's easier to value a fixed income security. Here, there is going to be some sort of a projection of the cash flows, which will involve a little bit of advanced techniques as we go along. We'll start with the simplest of techniques, and then as we continue graduating in finance, then we'll probably learn more about some of these concepts on evaluating and projecting cash flows of a company. To the expectation of returns, this R is not as simple as fixed income. In fixed income, all this R needs to be is the yield to maturity of a particular kind of a bond. And for a similar bond, you'll have a similar return expectation. So for all practical purposes, the R is fairly well defined. In the case of equities, however, it becomes a little bit more complicated because your choice versus my choice, your expectation from a company versus my expectation from another company is not so easily replicable. There are a variety of factors that affect the expected returns in a particular company, right? Expected returns is a function of a variety of things in the company and not just the fact that two AAA rated bonds will have similar expected returns. Here, two AAA rated companies or companies with AAA rated bonds may still have different expected returns expectation from their equities, right? And that's where it becomes a little bit more tricky. Third, unlike fixed income securities, where there is a defined maturity, the cash flows may not be finite in equities. So there is possibly no definite maturity, right? A company might exist to infinity. So it's quite possible that there is no definite maturity of a particular set of cash flows. Here, we are assuming that it ends at year end. That's not necessarily true in all the cases. So as we go along, these are some of the challenges that we will face. We will start with the simplest mechanism of trying to value a company and the stock price and what kind of return we can make out of that company. And then we will slowly remove all the basic assumptions that we have made to arrive at a point where the cash flows are not fixed, where expectations become a little bit more complicated, and more importantly, the cash flows may not be finite. You could have a company existing till infinity, in which case you have to basically find out the cash flow in the infinite tier and discount it with 1 plus r raised to the power infinity. Now that becomes difficult because mathematically it's not possible to divide, to find that value. So we'll have to kind of simplify our analysis as we go along, use some assumptions in this entire process, and thereby try and arrive at the stock price of a company. Right? First things first, we'll start with the simplest of mechanisms of stock price valuation. Right? Case one, we'll keep increasing the complexity as we go along. Let us assume a company whose stock price today is rupees 100. It is expected to pay a dividend of rupees 100 next year, and the stock price is expected to rise to rupees 112. What is the expected return? Right? Now, when we look at the expected return, you will add the dividend that the company gives, that's 4 rupees, right? And you'll find what is when you sell the stock next year, you will get 112. You have already paid 100 for it. So that's effectively 12 rupees that you have made on account of selling the stock at 112. And you paid a price of 100. So effectively, the value we get is 4 plus 112 minus 100 divided by 100, right? So that gives me 16%. That's the expected return from this particular stock, right? Valuation of stock, case one. If I have a company's stock price given today, and we know what is the expected price after a year, or maybe 2 years or 3 years or whatever that period is, and we know the dividend of that year, let's say the next year, then we can find out what is the expected return from a particular stock. Fair enough, straightforward. So we can generalize this equation now. Generalizing, the expected return from a stock is the expected dividend next year plus the change in price, P1 being the expected price next year, P0 being the current price, divided by P0, which is the initial amount that you have paid. This is the expected return from a particular stock, right? Now let's try some mathematics on this. So far so good. We know the expected return and hence it becomes simpler. We are saying that the expected return R is equals to the dividend D plus P1 minus P0 divided by P0, correct? Let's do some basic mathematics on it. I'll take P0 on the left hand side. So this becomes R multiplied by P0 is equals to dividend plus P1 minus P0. I'll take P0 on the left hand side. So it becomes P0 plus R into P0 is equals to dividend plus the next year price. I can take P0 common here. So we can take out the price here into 1 plus R is equals to dividend plus the price next year. And thereby the price right now is going to be dividend next year plus price next year divided by 1 plus the rate of return, right? So mathematically, I can take the current price on the left hand side, which is P0, and the equation for the current price turns out to be dividend plus the price next year divided by 1 plus R, or the present value of the dividend and price next year, right? In other words, we are saying the present value of dividend and price next year is what we are trying to find out as the stock price, right? That's going to be the stock price. So let's revert the question. If we want a return of 15% from a stock, right, whose price is expected to be rupees 120 next year and is expected to give a dividend of 3 next year, what is the price we should pay today, right? So this was the equation. What we did was we effectively found out that P0 is going to be dividend plus price P1 divided by 1 plus the expected return. Do we have these values with us? We do. We do have all these values with us. So let's look at the values. We are saying the dividend is 3, the price next year is 120, and our expected return requirement is 15%. So that's going to be 123 divided by 1.15, 1.15 being equal to 1 plus 15%, right? When we solve for this, we get the price of the stock. So let us actually go to our Excel file and discuss both of these on the Excel file itself, right? The first question we see on our Excel file is the generalization of the first question we saw, which was if we get a dividend of 4, let's put a bracket, if we get a dividend of 4 and price change is 112 minus 100, then the return is given by this equation, which gives us 16%, right? Our second question says if the dividend is 3 and the price next year is 120, what is the price I should pay right now in order to get a return of 15%, right? So what was the equation? We had written the equation. Let's kind of finalize the equation again. We are saying dividend next year, remember, plus price next year divided by 1 plus R, present value of these two set of cash flows. So that's what we're going to do. Let's find the present value of these two set of cash flows. That's 3 plus 120 divided by 1 plus 15%. We should not be paying anything more than 106.96 if I want to round it off, anything more than 107 if we want a return of 15% on this stock. If I want a return of 12%, then we are okay paying 109.8. If we want a return of 20%, the maximum price we should be willing to pay should be 102.5, right? So that's based on what the assumption or the data points we are given. Simplest of cases, when we know what is the stock price next year for the company, when we know what is the dividend they are going to give next year, and we have a set of either expected return given to us or the current price given to us, we can calculate the missing data from our equation that we have just seen, right? That's the first case. That's the simplest case that we have, where we have a certain stock that is given to us and we have the data around some of its dividends and the price next year. Let's complicate the case a little bit. Let's take the next case where a company is going to pay the dividend for the next 3 years, and then it'll close the business. So when it closes the business, it'll sell all the assets, and whatever proceeds are available, those proceeds would be distributed in all the shareholders. Let us assume a company that will exist for 3 years, that gives a dividend that grows by a steady growth rate. At the end of 3 years, the business will sell for a price that would give the value of 120 per share, right? So this final value is in a way similar to the principal that we were getting in our bond scenario. The dividends are still uncertain, but if we assume that they are growing at a steady growth rate, to that extent we will be able to project the three dividends, and the final value is in a sense similar to the principal as we just saw. That's going to be 120, right? If we want a certain rate of return, we can find out what is going to be the price. Let's see that. Assume a dividend value of rupees 3 growing at 10% every year, and assume that the expected return out of this stock is 15%. Two questions. First, what price would you be willing to pay for this stock? And second question, if the price paid is 103, then what is the expected return from the stock, right? So what is the price you will pay in the first year? You're getting 3 rupees as dividends, which is here. This grows by 10%. So grows at 10% and then again grows at 10%, right? The dividend keeps growing at 10%. So the dividend value goes to 3 into 1 plus 10% and 3 into 1 plus 10% whole square. You find the present value at your expected rate of return. And finally, the 120 bucks in the last year also get discounted at the same 1 plus 15% raised to the power 3. To kind of understand this, it will be good if we can go back to our Excel file once again and try and solve the question there. So that's the data that we have essentially. Cash flows are growing at 10%. We have the first year cash flow available with us. Let's try and build in the cash flows for the next year. Second year is going to be 3 into 1 plus 10%. And I'm going to freeze this 10% so that the third year also gets projected separately, right? So now we have dividends for the 3 years. The first year dividend is 3 rupees. The second year dividend is 3.3, growing by 10%. And the third year dividend is 3.63, growing by another 10%. At the end of the third year, the business gets sold and what you receive is 120 rupees per share at the end of the third year as well, right? So effectively, we have this data point set or data set available with us, which gives us this set of values. Now we have to find the present value, assuming a certain return, right? What is that return? We are saying that the expected return is 15%. So we have to find the present value of this set of cash flows at this 15% return. Can we do that? So that's equal to, I'm going to generalize the formula, which is 3 plus 0. And I'm doing that because the last year has both the values, divided by two brackets, 1 plus 15%, freeze 15%, raised to the power 1. Correct? 1 plus 15% raised to the power 1, and close the bracket again, and we get the value, which is 2.61. I can find the next value, which is 2.50, and we can find the third value, which is 81.29, right? If we add all the present values, this is very similar to what we have done for bonds as well. We get the stock price is 86.39. If you pay 86.39 for the stock, you're going to get this set of cash flows, right? We could also have done this separately, where let's say we say that this is my first year cash flow, and I'll just add both of them so that we get the total cash flows. These are the set of cash flows. We could have found the net present value as well using the formula of NPV, return 15%, and this is my set of cash flows. We'll get the NPV as 86.39, which is just what we just calculated, right? Now we are being said that someone goes and actually pays 103 for this stock. If you pay 103 for this stock, what is the expected return going to be, right? Now that again you will recall is like an extension of your IRR formula or calculation of the rate. What is being said is that in the equation is something like this. Someone has paid 103 and you are supposed to solve 3 divided by 1 plus R plus 3.3 divided by 1 plus R square plus 120 and 3.6, so 123.63 divided by 1 plus R cube. You have to solve this for R. It can be done by using the function IRR, right? The first outflow is going to be minus 103 in that case, right? So let's go up and let's see what is the cash flow set. This is the likely cash flow set that we are talking about. If we add total cash flows, that becomes minus 1033 and 3.3 and 123.63. Dividend growth rate is assumed to be 10%. What is the return on the stock? Can we calculate using IRR? We can just select this set of data and the IRR works to 8.27%. Right? The IRR works to 8.27%. If you want to recheck this entire data, if I put 8.27% in our first question equation, we get the sum of present values as 103. So the calculation is absolutely correct. 8.27% is the return that someone will make if they buy this stock at 103, right? So given that we have the data around what is the company's stock price today and what is the final future value expected when you are closing down the business, and you know what dividends are growing at, you can find the expected rate of return. If you have dividends and final value of the company available with you and you have a percentage return, then you can find the price today. So given a few out of these data points, we have 4 or 5 broad data points which are available. Dividends and growth are anyway needed. So that's like a single data point. Then you have the final value. You have the expected return. And then you have the price, which is the fourth one here. Given 3 of these, you can always find the fourth one. If you have today's price, if you have dividend and growth rates, and you have the final values, you can calculate the final price as well, or the expected return. So given 3 out of these 4 data points, you can calculate the final one in this equation, right? This is the second case of a stock valuation where we are saying there is a dividend that is growing at a certain growth rate, but there is a finite set of cash flows. At a particular point, the company ends its operations. At that point, they close the business and give you whatever is the value of the company at that point of time. That final value is available, just like the principal in the case of a bond. Intermittent cash flows are available, which are growing at a certain growth rate, dividends growing at a certain rate. Discount rate is available, which is the expected return, and you calculate the stock price based on that. That's the second case that we have. As we go ahead, we'll start removing the assumptions of finite set of cash flows as well. That will follow in the next video.